They take finance from the investors that might be for the consumption sometimes or for the productive investments. Those financial assets or the securities like stocks, debentures, bonds, etc., which are traded in the financial markets. Commercial banks are those banks which act as the intermediary between the investors and the borrowers. Hello everyone, I am Niklavati S, Faculty of Commerce, Vidhyaashram First Grade College, the Temple of Excellence, MYSURU. I welcome you all for the sessions on the subject Financial Markets and Services. So, let us start with the first chapter, that is Overview of Financial System. So, in this whole session, we will be understanding what is financial system is all about and what are its constituents. As we all know, finance is the lifeblood of any organization, and financial system is an important part of any economy, and it is the backbone of any economy which serves as a framework and facilitates the flow of funds from the borrowers and the savers. So let us see what is financial system is all about in detail. The financial system. So in this, it is important that the financial managers working in this whole network of finance and the investors don't operate in a vacuum, rather they make decisions within a large and complex financial environment. So all these financial managers and investors are involved with many financial decisions and transactions on a day-to-day basis, and they are all involved with this complex financial environment. And this environment or this system of financial market or a financial system consists of the financial markets and institutions, tax and regulatory policies, and the state of the economy. So all these are an important constituent which make or which build a financial system, like whether it can be the financial markets or institutions, tax or regulatory policies. And the environment both determines the available financial alternatives and affects the outcomes of various decisions also. So thus, it is very crucial that investors and financial managers have a good understanding of the environment in which they are operating. So, this financial system is a very complex structure consisting of various financial institutions, financial markets, financial services, etc. So, the financial system is a very necessary element of any economy for the development of the economy or for the growth and prosperity of the economy. So, basically, the financial system is a set of institutions such as banks, insurance companies, and stock exchanges that permit the exchange of funds. So here the important concept is whatever the financial system that is built by the constituents of institutions or the companies or stock exchange, it is for the purpose of exchange of funds in order to make the flow of funds in the economy. So it connects the investors and the borrowers to have a flow of funds between them. So the financial systems, it exists on firm level or regional level and at global levels also. So here it involves borrowers, lenders and investors. These people exchange current funds to finance projects. So either for consumption or for productive investments. So sometimes whatever the finance or the borrowers, they take finance from the investors that might be for the consumption sometimes or for the productive investments and to pursue a return on their financial assets. So this exchange of funds happens to get a return on their financial assets. So this financial systems involves various decisions that are taken by the financial lenders or the borrowers to take or decisions regarding which projects to be get financed or who should finance it, and what are the benefits in the future, what is the amount of risk involved in the amount borrowed. So all this, and let us see some of the important components of financial system. So the whole financial system is formed out of these four important components. So these includes the financial institutions. So here the financial institutions are nothing but those platforms or the organizations like banks or insurance companies, etc., which facilitate the flow of funds between the borrowers and the lenders. So then we have the financial markets. So it is also one of the important component of the financial system, where the financial market is a platform where the buyers and the sellers of the financial securities or the financial assets come together in order to determine the price of these financial securities or the assets based on the supply and the demand. So next we have is financial instruments. So the financial instruments are those financial assets or the securities like stocks, debentures, bonds, etc., which are traded in the financial markets. And the financial services are all those services which are provided by the banks or the insurance companies, even the payment systems. Say for example, UPI payments. So all these are services that are provided by a bank. So this consists of the financial services. So the financial institutions, markets, the financial instruments and the services are they are the components, and they form together, they make a financial system. Now let us see one by one each component. So first we have is financial institutions. Financial institutions are entities that mobilize savings from individuals, businesses and governments and channel these funds into productive investments. So the financial institutions are mainly the entities or the organizations which are there in order to take or mobilize the savings from individuals, business or governments and channelize or give them to the borrowers or the intermediaries or any kind of organizations, various companies, or they lend loans to individuals, etc., in order to have a productive investment. So these financial institutions act as intermediaries between savers and borrowers. So we can see that there are three kinds of financial institutions mainly. So these includes banking institutions. In banking institutions, we have two kinds of institutions. One is the commercial banks. The other one is central bank. So here basically the commercial banks are those banks which act as the intermediary between the investors and the borrowers or the savers or the borrowers. So they take money as they accept deposits from the savings of the individuals. So as deposits, they accept the savings from the individuals or the organizations and they lend loan to the borrowers in terms of loans or credit cards or any other services of lending. So next we have is central bank. So when it comes to central bank in India, our central bank is RBI, that is Reserve Bank of India, which acts as a monetary policy regulator, as well as it takes care of all the commercial banks in India. And not only that, it is the lender of last resort to all other commercial banks. Then we have is non-banking financial institutions. These are famously called as NBFIs. So NBFIs are companies or the entities like insurance companies, mutual fund or leasing companies. They offer financial services other than the traditional banking like the investments or asset financing, etc. And next we have is development financial institutions. So these particularly concentrate more on the development of the economy, like they invest for the long-term development in the field of agricultural or infrastructure, etc. So, for example, we have NABARD, that is National Bank for Agricultural and Rural Development, or we have SIDBI, Small Industries Development Bank of India, etc. So, these financial institutions play a major role by mobilizing the savings and financing fostering the economic growth by financing the long-term projects when it comes to infrastructure, industries, etc. They also provide finance for the productive activities, and not only that, they manage the risk by providing insurance and hedging services also. So next, let us move on to the next component, that is financial services. So the financial services refers to various services which are provided by the financial institutions to help individuals as well as the business to manage their finances effectively and efficiently. So here we have four kinds of financial services basically, and first one is fund based services. So these are the lending services like loans, leasing and hire purchase, and also investment services like mutual funds and portfolio managements. Next we have is fee based services, where these services are provided by the financial institutions but they charge some amount of fee, where it includes the advisory services, maybe regarding the investment or regarding the mergers and acquisition decisions, etc. It may also include investment planning, tax planning, and even the brokerage charges and underwriting commission that is charged for the advices given for trading purposes. Then the insurance services. So these are the services which are given by the financial institutions in order to cover the risks either through the health insurance or the property insurance or the life insurance, etc. And we have payment and settlement services. So these are like e-payment systems, for example, UPI apps like PhonePe, Google Pay. So all these payment mechanisms and systems are provided, like even the online payment methods that are there and provided by the banks or the financial institutions, all these comes under payment and settlement services. So these are all the services which are provided by the financial institution, and these financial services form an important component of financial system of the economy, because these financial services help the individuals and they support them to manage their wealth and risks. And not only that, they assist the organizations and help them to get involved in the productive activities by funding them. And they also promote innovation by funding startups. Moving forward, next component of the financial system is financial markets. So it is also one of the important component of the financial system of the country, where these financial markets are the platforms where the financial instruments like stocks, bonds and derivatives are traded, and they enable the exchange of funds between the savers and the borrowers. And these types of financial markets may be divided into the money market or the capital market based on the term of the securities or the financial instruments, and it may also include the foreign exchange market and derivatives market, where in the money market it deals with short-term securities like the certificate of deposit or the treasury bills or the commercial papers, etc. And they provide liquidity to the businesses and the government. Whereas in capital market, it includes long-term securities like shares and bonds. And not only that, in the capital market, again it can be divided into the primary market and the secondary market. In the primary market, the new securities are issued for the first time, like stocks like IPO, that is initial public offering. Whereas in secondary market, this involves where the existing shares and stocks are traded. And next we have is foreign exchange market. So here It facilitates the exchange of currencies and it is very crucial for the international business and investment. Then the derivatives market deals in the financial contracts that are made out of the value of the underlying assets that are there by either the currencies or the stocks, etc. Various instruments includes future options and swaps. These financial markets enable liquidity by the selling and buying of the assets, various financial assets, and also they determine the price of these financial securities based on the demand and the supply, and they mobilize savings for productive investments. And next important component includes the financial instruments. So here the financial instruments are the contracts or claims that represent an asset to one party and a liability to another. So they can be classified into debt, equity or derivative instruments. So again there will be a borrower and there will be a lender here. So here they deal with either the contracts or an asset. For example, a person called A borrows amount from B. Then A is liable to pay the amount to B and B holds some kind of contract paper or contract instrument or an asset. So here one person represents asset to one party and the liability to the another. So they can be classified into debt, equity and even the derivative instruments, whereas these types of financial instruments includes that may be debt instrument, equity instrument or hybrid instruments and derivatives. So when it comes to the debt instruments, so it includes various kinds of bonds and debentures. So these debt instruments represent borrowed funds and they provide interest to the investors, whereas equity instruments include the shares or the stocks. So here it again gives the shareholder or the equity holder some of the rights that he can be the owner of the business organization. They offer return in the form of dividends and capital gains. So next we have is hybrid instruments. So it's just like a mix of the equity as well as the debt funds. Say for example in hybrid we have preference shares where a fixed amount of interest will be paid to the investor on a regular period basis. And the derivatives are the contracts whose values depend on the underlying assets or whose values are derived from the underlying assets. And these includes futures, options and swaps. These financial instruments play a major role as they provide or they facilitate the investment as well as the savings. They provide mechanisms for raising capital and they also diversify the risk through hedging sources. So to sum up, as we can see, all these, the four important components are forming a financial system. So as we can see the summary table here, the financial institutions are entities that facilitate savings and investments. For example, you can remember banks, insurance companies and mutual funds. Whereas financial services are the services provided to manage the finances and risks. For example, loans, insurance, advisory and mutual funds. The financial markets are the platforms for trading the financial instruments like stock market, we have BSE and NSE, and the forex market and money market. Whereas the financial instruments are the contracts representing financial assets or liabilities. These may include bonds, stocks, derivatives and treasury bills. So this is all regarding the financial system and the components of the financial system. So hope you all have understood it. Thank you.